Imagine you've been playing a board game your entire life. You followed every rule. You went to college. You got the job. You bought the modest house. You saved 10% like they told you to. You did everything right. Now imagine discovering that while you were playing by the rules, someone quietly rewrote them. The money you saved lost half its value. The house you bought tripled in price, but so did every other house, so you can't move up. The stocks you don't own went up 400%. The wages you do earn went up 25%. You're not losing because you played badly. You're losing because they redesigned the game. Between 2008 and 2023, the American middle class lost $50 trillion in relative wealth, while the top 1% gained $35 trillion. This is the largest peacetime wealth transfer in modern history. Economists call it recovery. The Federal Reserve calls it necessary, the government calls it a success. But three numbers tell a different story. The middle class isn't struggling because of bad choices or bad luck. The middle class is being systematically destroyed, and the destruction has a blueprint. Here's what you were told happened. The financial crisis of 2008 nearly destroyed the global economy. Banks collapsed, credit froze, unemployment spiked to 10%. The Federal Reserve responded with emergency measures, interest rates cut to zero, quantitative easing programs that pumped trillions into the financial system, unprecedented intervention to stabilize markets. It worked. The S&P 500 recovered and then soared, climbing 400% from its March 2009 bottom. Unemployment dropped to 3.5% by 2019, the lowest in 50 years. GDP growth returned. Corporate profits reached record highs. The official message was clear: crisis averted, recovery complete, the system saved. Treasury secretaries gave speeches about resilience. Federal Reserve chairs testified that unconventional policy prevented a second Great Depression. Economists published papers celebrating the most successful monetary intervention in history. The data seemed to confirm it. Stock markets at all-time highs, real estate rebounding, consumer spending growing. Every headline told you the economy was healed, but three specific numbers reveal what actually happened beneath that surface. First, the Federal Reserve's balance sheet. In 2007, it held $870 billion in assets. By 2023, that number reached $8.9 trillion. That's more than a 10 times expansion. The Fed created over $8 trillion in new money through quantitative easing, using it to purchase treasury bonds and mortgage-backed securities. Where did that money flow? Directly into financial assets. When the Fed buys bonds, it pushes bond prices up and yields down. When yields fall, investors chase higher returns in stocks. The S&P 500 companies saw their total market capitalization rise 350% between 2008 and 2023. Meanwhile, median household income rose 25% in nominal terms. Adjusted for inflation, real purchasing power increased only 3% over 15 years. The mechanism is simple. $4.5 trillion in quantitative easing money flooded into assets that the middle class doesn't own at scale. The top 10% of households own 89% of US stocks. The bottom 50% own 0.6%. For every $1 trillion in asset appreciation, the wealthy captured $890 billion while the bottom half captured $6 billion. Second mechanism, home ownership became a wealth trap disguised as wealth building. In 2008, median home equity stood at $85,000. By 2023, it reached $300,000. That sounds like prosperity until you examine who's buying homes now. Corporate and institutional investor purchases jumped from 8% of the market in 2010 to 28% in 2023. BlackRock, Invitation Homes, and similar institutional landlords acquired over 500 to 74,000 single-family homes between 2020 and 2023 alone. The result? First-time home ownership rates collapsed from 45% in 2010 to 29% in 2023. The middle class owns the single home they live in, while investors accumulated rental properties generating passive income streams. Your home equity grew, but you can't access it without selling into a market where every comparable property also tripled in price. Meanwhile, investment firms converted home ownership from wealth accumulation into permanent rent extraction. The third number exposes the interest rate transfer. Corporate debt exploded from $3.1 trillion in 2008 to $10.5 trillion in 2023. Yet corporate interest expense as a percentage of profits actually declined from 18% to 12%. The Federal Reserve held rates at 0 to 0.25% for 94 consecutive months, allowing corporations to refinance at historic lows. Those same years, credit card interest rates averaged 19.5%, the highest spread in Federal Reserve history. Banks borrowed from the Fed at near zero and lent to consumers at 20 times that rate, extracting the difference. This wasn't recovery. This was systematic restructuring. The system didn't break in 2008. It was redesigned. And the middle class was never meant to benefit from what came next. Understanding how this wealth transfer operates requires examining the 4 specific policy mechanisms that built the trap. Zero interest rate policy wasn't just emergency response. It was class warfare disguised as crisis management. Between 2008 and 2022, the Federal Reserve held the federal funds rate below 1% for 167 out of 168 months. The impact on savers, predominantly middle-class households, totaled $3.8 trillion in lost interest income according to St. Louis Fed calculations. The impact on asset holders who could borrow at those suppressed rates? $4.1 trillion in increased asset valuations from access to cheap capital. The arithmetic is precise. For every $100,000 in savings, middle-class families lost $30,000 over a decade compared to traditional 3% savings rates. For every $1 million borrowed at 2% instead of 6%, wealthy investors gained $400,000 in reduced costs over that same decade. This wasn't accidental. This was a deliberate transfer from those who save to those who borrow to invest. Quantitative easing functioned as the direct pipeline. The Fed's asset purchase programs between 2008 and 2022 totaled $4.8 trillion. Where that money flowed is documented in the Federal Reserve's own flow of funds data. 73% went into stocks and bonds. Who owns those assets? The Fed's survey of consumer finances from 2022 shows the top 10% own 89% of US equities. The bottom 50% own 0.6%. For every $1 trillion in quantitative easing, the top 10% captured $890 billion in gains. The bottom 50% captured $6 billion. This isn't inequality as a side effect. This is inequality as the mechanism itself. Regulatory capture completed the architecture. Dodd-Frank passed in 2010 with explicit promises to break up too big to fail banks. The outcome was the opposite. In 2008, the top 6 banks controlled 43% of total banking assets. By 2023, those same 6 banks controlled 58% according to FDIC data. Regional banks, the traditional lenders to middle-class borrowers and small businesses, declined from 8,500 institutions to 4,100. They were either consolidated into larger banks or crushed by compliance costs that only massive institutions could afford. The result? Lending became centralized in institutions that prioritized large corporate clients and securitized consumer debt over relationship banking with middle-class customers. The tax code restructuring locked in the gains. The 2017 Tax Cuts and Jobs Act dropped the corporate rate from 35% to 21%. Corporate tax revenue as a percentage of GDP fell from 1.9% to 1.1%, reducing federal revenue by $2.3 trillion over the following decade. Who received those cuts? 83% of corporate equity is owned by the top 10% of households. Who covered the shortfall? Payroll taxes, paid predominantly by middle-class workers, remained at 6.2%, unchanged. The tax burden shifted downward while the benefits flowed upward. Boeing provides the case study that synthesizes all 4 mechanisms. Between 2008 and 2019, the company spent $43 billion on stock buybacks, artificially inflating share prices and enriching executives and shareholders. When COVID hit, Boeing received $17 billion in government support. Executive compensation exceeded $200 million during this period. Meanwhile, the company cut 30,000 middle-class manufacturing jobs. The system rewarded financial extraction over productive investment. It rewarded asset manipulation over wage growth. It rewarded those who owned capital over those who provided labor. This wasn't market failure. This was market design working exactly as intended. The wealth concentration didn't happen gradually, it accelerated. In 1989, the top 1% held 23% of total wealth, while the middle 60% held 32%. By 2007, just before the crisis, the top 1% had 29% and the middle class had 28%. The distribution was approaching balance. Then came the restructuring. By 2023, the top 1% controlled 35% of all wealth, while the middle 60% had fallen to 22%. Sometime around 2015, a historic crossover occurred. The 1% surpassed the entire middle class in total wealth for the first time in modern US history. This wasn't erosion. This was inversion. The mechanics of this inversion become clear when you compare what rose in price versus what you actually need to buy. Healthcare costs for a family of 4 increased 140% since 2008. College tuition rose 180%. Home prices climbed 75%. Childcare costs jumped 115%. Meanwhile, the S&P 500 gained 400%. The pattern is precise. Essentials that you must purchase rose 100 to 180%. Assets that generate wealth rose 400%. If you owned assets, you got richer. If you earned wages and bought necessities, you got poorer. The gap isn't about individual choices. It's about systematic price divergence between what the middle class buys and what the wealthy own. Real disposable income tells the story in one number. In 2000, the median household had $12,400 per year available after covering necessities. By 2023, that figure had collapsed to $6,800. That's a 45% reduction in actual purchasing power for discretionary spending, investment, or emergency savings. The Federal Reserve's own 2023 survey documented the result. 64% of Americans now live paycheck to paycheck. This isn't lifestyle inflation or poor budgeting. This is systematic income compression. Debt dependency filled the gap that wages couldn't cover. Consumer debt stood at $2.6 trillion in 2008. By 2023, it reached $4.8 trillion, an 85% increase. Median household income rose from $52,000 to $74,000 over the same period, a 42% increase. Debt is growing twice as fast as income. The middle class is borrowing to maintain a lifestyle that wages no longer support. This is unsustainable by definition, yet it's treated as normal economic function. International comparisons reveal how extreme this has become. The US Gini coefficient, which measures income inequality, reached 0.41 in 2023. That's the highest among all developed nations. Germany sits at 0.29, France at 0.32, Canada at 0.33. The United States now has inequality levels closer to Russia at 0.38 and China at 0.47 than to Western Europe. This isn't American exceptionalism. This is American extraction. Then COVID accelerated everything. The $6 trillion response between 2020 and 2021 broke down as follows. $800 billion to individuals through stimulus checks, $1.7 trillion to businesses through PPP and grants, $3.5 trillion in Federal Reserve balance sheet expansion. The stock market gained $15 trillion in value during those 24 months. The top 1% added $4.8 trillion to their net worth. The bottom 50% gained $380 billion. That's a 13-to-1 ratio. The wealth gap expanded faster in 2 years than it had in the previous 12. By 2022, billionaire wealth had increased 70% since 2020, while real wages for the bottom 60% were negative. The crisis wasn't coming. The crisis had already arrived and been normalized as recovery. This restructuring isn't limited to America. The coordination across borders proves this is global architecture, not domestic accident. Between 2008 and 2020, the Federal Reserve, European Central Bank, Bank of Japan, and Bank of England all implemented zero interest rate policy within 6 months of each other. Their combined balance sheets expanded from $3 trillion in 2008 to $25 trillion by 2021. Every major central bank chose the same policy at the same time: sacrifice savers to inflate assets. The pattern reveals intention. Global asset inflation made stocks unreal. Estate unaffordable worldwide while interest income evaporated for anyone holding cash savings. The World Economic Forum formalized what central banks had already implemented. In June 2020, the organization announced the Great Reset Initiative, proposing stakeholder capitalism, ESG mandates, and digital currency systems. The attendee list at Davos meetings from 2020 to 2023 included every major central bank governor, every G7 finance minister, and CEOs controlling over $120 trillion in assets. Klaus Schwab's statement that "you'll own nothing and be happy" wasn't metaphor. It was policy direction describing the subscription economy model that prevents wealth accumulation through ownership. Within 3 years, corporations controlling those $120 trillion in assets had adopted ESG frameworks that subordinate profit maximization to stakeholder coordination. Central bank digital currencies represent the endgame of this control architecture. 114 countries representing 95% of global GDP are now exploring or piloting CBDCs, according to the Atlantic Council's tracker. China's digital yuan already has 260 million users, processing $250 billion in transactions. The key feature isn't convenience, it's programmability. Unlike cash, which is anonymous and uncontrollable, central bank digital currencies allow real-time tracking of every transaction and algorithmic control of spending limits. The Bank for International Settlements published a paper in 2023 called Project Aurum detailing exactly this capability: embedded supervision, where central banks monitor and potentially restrict financial activity in real time. The own-nothing economy is already operational. Global institutional investment in single-family housing exceeded $300 billion between 2020 and 2023. BlackRock CEO Larry Fink stated in 2023 that Americans will be a nation of renters. This isn't prediction, it's business model. The shift from ownership to subscription extends beyond housing into vehicles, software, and even appliances. The economic impact is permanent. Wealth accumulation through asset appreciation becomes impossible when you rent everything. You pay monthly fees that generate returns for asset owners while building zero equity yourself. Global debt levels make this system irreversible through conventional policy. Debt to GDP ratios climbed from 226% in 2008 to 356% in 2023, according to the Institute of International Finance. Advanced economies went from 282% to 432%. Who holds this debt? Increasingly, central banks and institutional investors. Indebted populations can't rebel. They can't save. They can't exit the system. Debt functions as control mechanism. This coordination is openly documented, not hidden. The IMF published a paper in 2022 acknowledging that reducing inequality might require accepting lower growth, yet they chose growth for asset holders. The BES published research in 2021 admitting ultra-loose monetary policy has distributional consequences, then recommended continuing those exact policies. BlackRock published a paper in 2019 called Going Direct, proposing coordination between central banks and fiscal authorities to inject money directly into the economy. That proposal was implemented globally during COVID. The middle class faces unaffordable housing, negative real wage growth, and systematic restructuring of property rights and financial privacy. All while being told the economy is strong and recovery is complete. Your wealth became a policy variable. The middle class isn't struggling because of poor financial decisions or lack of discipline. You're struggling because your purchasing power was sacrificed to prevent the collapse of a financial system that would have otherwise destroyed itself. Every dollar of savings you lost to suppressed interest rates, every percentage point of real wage decline, every asset price increase that put ownership beyond reach, these weren't market outcomes. These were policy choices with your wealth on one side of the ledger and financial system stability on the other. 3 realities define your position in this restructured system. Your savings are designed to lose value. Real interest rates, meaning interest minus inflation, have been negative 80% of the time since 2008. On $100,000 in savings, that represents $25,000 in purchasing power, deliberately eroded through intended policy. Every dollar you save is a dollar not circulating, not inflating assets, not supporting the debt-based system that requires constant monetary expansion. Your thrift became a systemic problem to be solved through your impoverishment. Your income is designed to lag behind asset appreciation. Labour's share of GDP fell from 64% in 2008 to 57% in 2023, according to Bureau of Labour Statistics data. That 7% didn't disappear. It transferred to capital in the form of corporate profits and asset appreciation. In dollar terms, $1.4 trillion annually shifted from wages to capital returns. Wage growth threatens profit margins and stock valuations. Asset appreciation doesn't. The system rewards ownership over work because owners are the constituency that policy protects. Your ownership is being systematically restructured. The home ownership rate for Americans under 35 dropped from 42% in 2008 to 38% in 2023. Stock ownership for the bottom 50% was already near zero and remains there. Pension coverage collapsed from defined benefit plans that guaranteed income to 401k accounts that lose half their value in every crisis. Owners accumulate wealth through appreciation. Renters and subscribers generate revenue for those who own the assets. The transition from ownership economy to rental economy isn't evolution, it's extraction. But the architects didn't account for awareness. When 64% of Americans live paycheck to paycheck despite record employment, people notice the contradiction. When billionaires gain $5 trillion during a pandemic while inflation hits 9%, people feel the transfer. When economists declare the economy strong while you can't afford a house your parents bought at 25, the narrative breaks. The system depends on your belief that struggle is personal failure rather than systematic design. That belief is failing. Your response must mirror the mechanism in reverse. The system keeps you asset poor and debt dependent. Your strategy must prioritize asset acquisition and debt elimination. Every percentage point of income redirected from interest payments to assets compounds over decades. High-interest consumer debt averaging 19.5% represents the largest wealth drain by design. Eliminating it is the first countermove. Hard assets that survive monetary debasement, real estate, even if fractional, precious metals, productive equipment, provide the hedge that savings accounts no longer offer. Gold appreciated 600% during the quantitative easing era, while savings accounts declined in real terms. Diversification isn't disloyalty. It's recognizing that dollar-denominated savings are designed to lose. Income tied to assets rather than labor alone positions you on the side of policy that wins. The system rewards capital, not work. Rental income, dividends, business equity. These generate returns that benefit from the same policies that suppress wages. This isn't endorsing the system. This is surviving it by positioning outside the mechanisms of transfer. They designed a crisis to save the financial system. You must design your response to save your financial future. The great theft continues, but only if you don't see it happening.